The chair recognizes the gentleman from Michigan, Mr. Peters.
Thank you, Mr. Chairman, and Chairman Bernanke, thank you for being here today and for your service. Last week, the Bank of Japan announced that they were going to maintain their current monetary policy, which, as you know, includes a significant devaluation of the yen for the purposes of improving the competitiveness of Japanese exports. The yen has fallen in value almost 30% compared to the dollar since last year. And Japan, as you also know, is joining the U.S.-led Trans-Pacific Partnership trade talks. I have raised a number of concerns about Japan's entry into the into the trade talks until they open their markets, particularly to U.S. autos. And while they continue to manipulate their currency, this increases my concerns, and it could make our trade deficit even worse. I know in 2011 you expressed concern with China's devaluation of their currency, and I'm quoting you saying, right now our concern is that the Chinese currency policy is blocking what might be a more normal recovery process in the global economy, and it is to extent hurting our recovery. Would you please discuss kind of your views on Japan's currency policy and its impact on the economy, and do you believe that their currency policy is hurting the economic recovery in the globe right now?
Yes, there's some fundamental differences between China's policy and Japan's policy. China has managed its exchange rate and kept it for many years below its equilibrium level in order to increase its exports. That's what economists call a zero-sum game. What they gain, we lose, basically. The Japanese approach is different. They're not manipulating their exchange rate. They're not directly trying to set their exchange rate at a given level. What they're doing is engaging on strong domestic monetary policy measures, trying to break the deflation that they've had for about 15 years, and a side effect of that is that the yen has weakened. The G20 and the G7 have discussed these matters, and the international consensus is that as long as a country is using domestic policy tools for domestic purposes, that would be an acceptable approach. Now, I recognize that movements in exchange rates do affect competition. You said you're from Michigan, right? Yeah, so I can see where your concern would come from. I think that it's in our interest, though, to see Japan strengthen, to see their economy grow faster. That'll increase our market there as well as the competitive supply. And over time, if they do in fact achieve positive inflation, that increase in prices there will partially offset the exchange rate movement. So I recognize the concern. I don't know how big an effect it has so far. I've actually talked to a couple of people at the auto industry at some of the companies to try and get their sense. But again, there is a difference, which is that Japan is trying to expand its overall economy, and therefore there's a benefit as well as a cost, and that benefit is a stronger Japanese economy and a stronger Asian market.
Well, to pick up from that point, so if you could kind of give me some sense, as you wind down your quantitative easing activities while Japan maintains this current policy, which is driving down the yen, do you believe that's going to have an impact on American manufacturing and exports as you wind down, as they continue that policy?
It could to some extent, but of course, as you know, for example, many Japanese producers produce in the United States, and there's a sense that for a number of reasons, including productivity and others, that U.S. manufacturing is actually generally becoming more competitive globally than it has been in some time. So I don't think that this change in the value of the yen would offset